For bond investors, inflation is traditionally the great terror. And now they have to assess whether Trump's tariffs will bring rising prices on a long-term basis. Bank of Canada admits it doesn't know. Our guest helps oversee $14 billion in fixed income investments. She says she's playing the bond market cautiously in terms of credit quality. She says junk credits and corporate debt have not generally been offering an adequate yield pickup over government bonds. We're joined by Heath, portfolio manager at Leith Wheeler Investment Counsel. Thanks very much indeed for joining us.
Thank you for having me.
Can we start off with inflation? Obviously, it's a topic number one for bond investors, but it is tough, isn't it? Are we going to see prices rising sustainably because of the tariffs?
Yeah, that's a great question. We've had a lot of concern coming out of the market on whether this rise in tariffs is going to cause a stagflationary scenario, one in which you see both inflation rise while at the same time growth is falling. Our view is that that's a less likely scenario because tariffs tend to be sort of a one-time change to the price impact, and going forward, ultimately, tariffs should be deflationary as they exert a downward pressure on economic growth. So the Bank of Canada's scenarios this morning, with the two scenarios, one being sort of a more benign 2% inflation outlook, and the other being a higher inflation outlook, but for a shorter period of time, we would agree that those two scenarios are likely how it will play out.
But as you know, during COVID, we learned just how intricately interconnected our global economy is, and the supply chain disruptions fed into each other and produced a much bigger boost in inflation than had been expected. I wonder, could a similar thing happen with the tariffs disrupting supply chains?
Correct. Yeah, that's one scenario that is also contemplated by the Bank of Canada, is that if you do get this feed-on effect whereby tariffs are rising price levels, but that's actually then leaking into the psyche of people's expectation for price inflation, and then you see wage pressure, inflation rise on that. So it could have a feed-on effect where we do have more sustained rise in inflation levels. But it's very difficult to predict. It depends on the extent of the tariffs, how significantly they're implemented, for what period of time we're in this highly uncertain environment, and also the tightness of the labor market.
Just looking at the 10-year Canadian bond yield, as recently as late 2023, it was not far short of 4.5%. It was about 4.3, 4.4. There's a one-year chart. It has now dropped to about 3.1%. So over the past year, a bit more, it's been pretty good to own bonds. Are you worried that the good times are over, that we could start seeing a backup in yields?
We are actually fairly constructive on fixed income as an asset class. At about a 3.10, we're still expecting longer term inflation in and around 2%. So you still are at a positive yield, real yield with fixed income. It is possible to see a lot of fluctuations around that, but we would welcome that as a buying opportunity in fixed income.
You are wary, though, of lower-rated non-investment grade credits and even corporate bonds. You think that in some cases you're not being compensated with an extra yield pickup for the extra risk?
That's right. For the past 5 years, Leith Wheeler has been running our core portfolios, both our Canadian universe portfolios and our U.S. sub-investment grade portfolios very low in credit. Corporate bonds have really been on a one-way street with spreads tightening significantly since COVID. And there's technical reasons to this as well. The fixed income corporate market in Canada is fairly constrained, so we have a lot of buyers chasing very few corporate issues. That puts pressure on spreads. But we've also had a very benign economic environment with fairly strong growth, robust employment over the past 4 years, which has really exerted pressures on corporate spreads. So as a result, we're trading at the 5-year low in our allocation to investment grade corporate bonds and high yield bonds. Recently, though, we've had this backup. So we entered the year with high yield spreads in and around 300. Where we're currently at around a 420. So we're selectively adding back in. But the caveat is that that range is pretty significant. Back in the Great Financial Crisis, we saw high yield spreads in and around 900, 1,000. So to put that into context, this backup is fairly small. And so we're taking this a little bit more from a cautious perspective.
Thank you very much indeed. Really appreciate it, Catherine.